Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending October 27th, 2023. So let's start with a look at this week's markets at the close on Thursday. Interest rates, the road was windy for sure, but now we're at a level that, interest rates, the 10-year rate in the US is flirting with the 5% level. Quite volatile at this level here. Positive this week. Still in negative territory so far this year, but good news for investors this week. Interest rates are a bit lower. Maybe we're at the peak. We think we're at the peak for leading rates. So the overnight rate from central banks, we think we're pretty much there. For the market rates, maybe now we're in. But let's see if the picture remains as volatile for the weeks to come. But at least volatility was positive for investors this week. For the stock market, negative pretty much everywhere. Interesting to see that the S&P 500 now year to date has crossed below the 9%, the 10% level, and we're flirting with 20% for the Nasdaq. We're at 30 recently. The Nasdaq now is officially in correction territory, so down 10% from the recent peak. For the S&P 500, we're flirting with correction too, although the peak was way back in January 2022, but from the peak that we've seen in July, pretty much down close to 10%. EFI, emerging markets, negative too. The price of oil down massively this week. The geopolitical situation remains fluid, so lots of volatility there, minus 6% on the week. Down on the CAD, down on the euro, and gold, interestingly, catching up with the S&P 500 on returns year to date, so doing its job as a geopolitical hedge. Let's start with the Bank of Canada. Are we done with rate hikes? We think we are. The odds are very strong that we're done with rate hikes. In our opinion, there's a slight possibility that we have another insurance hike at some point, but I would say the odds for that are pretty low, so it's an alternative scenario. Looking forward, we believe that it's time to keep interest rates high for a while and just let monetary policy give it the time it needs to do its work, to do its thing, bring inflation back towards targets. So we're targeting more second half of 2024 for the next move, which should be a rate cut. This is our base case scenario. Many things can happen until then, but we think maybe likely the next move is going to be a rate cut. And looking here at the scenarios from the Bank of Canada, we got that from this week's monetary policy report, the one that was published in October. You have forecasts here. The numbers in parentheses are the numbers from the previous forecast, which was published in July. So the number on top in every cell here is the actual forecast, and the parenthesis below is the previous forecast. So if we start with the first line, we see that for Q3, inflation expectations were revised higher from the bank. So they were expecting 3.3% inflation at the end of Q3. Now they're expecting 3.7%. Of course, Q3 is now behind us. We're in Q4 now, but this is to show that they were surprised with stickier inflation. And when you look at their forecast for the end of this year, on the right, 3.3 versus 2.9%, so still above the 1 to 3% range. And in the text, it's not here, but they are saying that they're expecting that inflation will fall below 3%, so get back within the range in mid-2024. And at the end of next year, we should be at 2.5 instead of 2.2. So that means inflation is seen by the Bank of Canada to be stickier than expected, warranting likely to keep interest rates higher for longer. On the bottom, you see that monetary policy is working because the economy is surprising negatively. So the bank has lots of information, lots of very good models to forecast the economy. But as you can see, the data coming in is pointing a dimmer and dimmer picture for GDP growth. So monetary policy is working on GDP growth, not as quickly as was recently expected on inflation. So likely warranting that rates stay high for a while. So this is the message we got this week. Turning at the US economy, we had an acceleration in Q3 of GDP and a strong one, 4.9%. We don't see this as a strong number. It was still, the details were relatively weak. Jump in inventories. We see that households have been dipping into their savings at a fast pace in Q3 to support the growth in GDP. We see that confidence confidence was higher for a few weeks during the summer. Now it's turned back lower. So I would say that the details are pretty weak, but we need to acknowledge the strength here in the overall figures that are published for GDP. But maybe just I've used this slide in the past in this review, and I'm using it extensively on the roadshow circuit, but it generally looks different this time when the Fed is done tightening. So there's two things here. So on the left, you have all of the recessions since 1947, since we have data from the NBER. And what we did here, we highlighted what the GDP growth number for the quarter just before the official start of the recession was. And if the number was positive, it's above the sticks. And if it was negative, it's below the sticks. So there's 12 recessions here, and as you can see, there's only 3 numbers that are below, that were negative, and all of the other numbers, there's 9 here, they were above. So 9 times out of 12, the quarter just before the start of a recession, GDP growth was positive, and sometimes it was even pretty strong. So the positive GDP number now has very little value in giving us a hint at the odds that we fall into a recession as soon as the coming quarter. So yes, 4.9%, but it doesn't really change the picture. So that's the message here. And on the right, you see that when the Fed is generally done tightening, 2000, 2006, I can go back further in time here. These are Bloomberg data, but we see that when the Fed is done tightening and the economy is still holding strong, the news about soft landing starts to jump up. And we know in 2000, when the Fed stopped tightening, eventually we had a recession in 2001, 2006, same thing. We did have a recession in 2008. So let's see if this time is different. So here the message is that we don't know if there's going to be a recession or not. Our macroeconomic framework suggests that a recession should be in order. The leading indicators are pointing in that direction. They're pointing towards a mild recession. Let's be clear here. It's not a 2008 or a 2020 for sure. Mild recession, but a recession still, so we're playing the odds here. It's still our base case that we have a mild recession, but we also acknowledge the odds that we're wrong here. So it's always about the probabilities. What's behind the current strength in the US economy? I mentioned there were a few things earlier, but just to dig maybe into charts for 2 things. When we hear about US exceptionalism recently, well, a lot of that comes from the growth in the US deficit. And this is the fiscal thrust we have on the chart on the left. Year over year, the size of the deficit in terms of percentage of GDP is up 4%. So there's 4% more GDP year over year that was created out of this growth in the deficit. That's a lot of wind into the sails of the US economy. And of course, it's not sustainable. This is what we see on the right. Now, the interest payments, these are quarterly data. Those are more stable data, but we have some more high frequency data, monthly data coming out. And in September, we saw that on the month, we did cross the defense budget in the US in terms of interest payments. So the next quarter, when we have the clean data, we'll see that the blue line has crossed the gray line. So it's not sustainable. You cannot grow the deficit forever, and at some point you need to move to fiscal restraint. And what that means is that fiscal policy will then be a detractor to GDP growth. So exceptionalism for now. The bill will have to be paid later, and when we pay that bill, likely we're going to be seeing the fiscal side holding back the US economy. So this is one of the factors that's important at play now. It's supporting the economy now, but should be a detractor in the future. Second one I want to highlight here, and that's the last one, the US housing market. In the US, when you buy a house, typically you take a 30-year fixed mortgage. That's a very important point here. Meaning that if you're a homeowner and you bought your house maybe somewhere in the last 10 years, interest rates were pretty low over the last 10 years. They were even lower during the pandemic. you have a 30-year mortgage that has a very low interest rate. Let's say you have a life event or you just want to change to move to a bigger house. You need to move away from your very low rate and lock in a new rate for 30 years fixed that's going to be higher. You can always refinance later, but you do have a hit on your interest payments at once, and that means that the market, the housing market in the US is starting to freeze up. This is what you have on the chart on the left. Existing home sales are falling like a rock, and new home sales are rising because people are forced, the buyers are forced to go to home builders now. So this is the situation. And on the right, if you look forward, you see that the new home sales, yes, they rebounded recently, but there are some surveys of home builders, and they ask a question about what's the foot traffic now for prospective buyers, and you see there was a blip higher in this summer. But now it's starting to fall again. So of course, if it costs too much to buy a house, likely you're gonna stay put and wait for a few years. So this is what's going on. So so in Q3, GDP was pushed higher by the residential sector because of these effects. But when you look forward, likely these effects could fade. So two elements here that I just wanted to highlight just to give some context around GDP. As I said, I could have brought the chart about the savings rate, which dipped in Q3. So people were using their savings to spend. Credit card delinquencies, car loan delinquencies rising. Consumer confidence, which had moved higher during the summer, but now it's turning back around. So you have all of this context here. That means that we tend to be careful about the recent GDP print in the US. So that was a lot of information. Now what to watch next week. We'll have August GDP, should be neutral on the month, at 1% higher year over year. Net change in employment and the unemployment rate, which was at 5.5% in September. In the US, we'll have a flow of information that's going to be impressive. We'll have the consumer confidence index from the conference board, should be lower. The JOLTS job opening should be down to 9,200,000 jobs in September. We'll have the ISM manufacturing and services indices, which should be stable. The Fed rate decision, no change is expected. The Fed, of course, looks at the details of GDP like we do now. Likely there's going to be seeing also some temporary effects, but with the strength of the print, the odds that we have another rate hike, they're very low, but they're not zero. So let's say it like that. And the non-farm payrolls down to 175,000 in October. So still positive, still healthy, but slowing down from the monster print of last month. So that wraps it up for the week. ia.ca/economy or iagam.ca/insights, two places where you can find us. It's always a great pleasure to serve you, and I'll see you again next week.